Hello, everyone. If we haven't met, my name's Andrew Samuelson. I'm a financial advisor here with Wild Wealth Management Group. Been a financial advisor now for about 10 years, but I joined the Wild Wealth team in November of 2015. Absolutely love being a part of Wild Wealth and the team here. A big part of the reason I joined the Wild Wealth team back in 2015 is the holistic approach that we provide to our clients. I personally put a large emphasis on financial planning and working with individuals and business owners to reach their financial goals. So with that said, let's go ahead and jump in to the presentation here. A couple more introductions I want to make briefly. So the presentation we're going to be going through today is about surviving market swings, investing strategies in uncertain markets. But let's talk about a couple other key people here other than myself. All right, so we do have several offices. These are the main offices, Scottsdale, Glendale, Tempe, and Payson. I'm personally officed out of the Scottsdale office, and today as we speak, I'm actually sitting at my home office. You can probably guess I'm in Gilbert, Arizona. These people, our clients, probably know their names a little bit better even than their advisors, because these are our support staff. These are the right arms of all of our financial advisors. If clients need anything, these are the people who make it happen. So special thanks to our support staff. So we are going to make a commitment to you, anyone who's listening to this video, that we'll do a couple things. One, I genuinely appreciate the investment that you're making in spending some time to hear this webinar. And for that investment, the return on investment hopefully is some general knowledge that you can implement going forward in your investment strategy. Also, will help identify some goals and hopefully help you create some goals. And then also we want to offer you a complimentary stress test of your portfolio to make sure that if and when we do have market corrections, that your portfolio is built to withstand those. So let's talk a little bit about market volatility. Primarily when we're talking about risk, we are talking about volatility, not the fact that you're going to lose money, but more the fact that on occasion, investments do go down. It's typically a temporary loss, and then those assets recover over time, hence the volatility. Political uncertainty, international conflicts, economic shifts, monetary policies, asset bubbles, and debt crises all factor into volatility in investment markets. So this slide is very, very interesting. I love this slide, not to go through each individual point of volatility and inflection point, but I really like the kind of the 10,000 foot view. Having a realistic expectation of the potential gains in while investing is important, but just as important is the realistic expectation of potential volatility or downsides to the market. Everyone, when talking about risk and volatility, always goes back to 2007, 2008, during the financial crises or the Great Recession. Investing can be somewhat analogous to riding a roller coaster. And the reason I say that is based on your financial plan, you'll have a interest point and a set exit point of each dollar that you invest, right? I have a goal to get married in 5 years. I have a goal to buy a new car in 2 years. These are exit points for those dollars. As long as you stay on the ride and you don't try to hop out midstream or mid-ride, the likelihood of you being financially injured are substantially lower than trying to jump off of a roller coaster in the middle of the ride. So yes, things can be volatile, but the longer the investment time horizon, the much better off you're going to be. So factors that influence the economy and financial markets. So it's no accident that it says economy and financial markets. Oftentimes people confuse the two or think that they're the same thing, and they're not, but they are related. So GDP growth, inflation and interest rates, employment conditions. Obviously, high unemployment is not a good thing for the economy or the stock market, and vice versa. Home prices, consumer spending, business investment, corporate profits, trade tensions, and also oil prices. All these things can influence the financial markets. So now that we have somewhat of a grasp on what the risks are in investing, or at least some of the risk, let's talk about some strategies and some things to be aware of while investing that can help us get through those times. So the first thing is to develop a sound financial strategy. If you were to take a road trip, as my family often, we often will drive up to Flagstaff from Gilbert, or maybe Pine Top, something like that. But before we do, we kind of go through a checklist. Does our car have gas? When's the last time we had the oil changed? Should we check the tires to make sure that they're properly inflated, especially if we expect to encounter snow? And do we have a spare tire? These are things that you would do before you leave. Developing a sound financial strategy is the same thing as checking the tires, making sure your oil is changed, and making sure you have a spare tire. If you are on your journey and you get a flat tire, if you have the spare, it's not really that big of a deal. Probably frustrating, but it's not the worst thing in the world that could have happened to you. But finding out that your spare is flat while you're on the side of the road, now that could potentially be a much larger event. So first of all, we start off by developing a financial strategy. And I personally work with my clients in developing this strategy by first starting off with a full financial plan. In order to develop a strategy, these are the things you're going to need to know. Your investment objectives, a time frame, very important, and your risk tolerance. And I would say that these things are in the proper order. Your investment objectives can be preserving your principal, meaning you don't really want to see a whole lot of down days when it comes to your portfolio. Objective of producing income, growth, long-term growth, and tax benefits can all be investment objectives. So I had a track coach that would always tell me that a goal is not a goal unless it's time bound. And what he meant by that was it's not good enough to say that you want to lose 10 pounds. It wouldn't be a goal until you said, I want to lose 10 pounds in 3 months. While investing in creating a financial strategy or plan, it works the same way. Your goals need to be time bound. Risk tolerance is very important. Oftentimes, our biggest risk is the person in the mirror. Bad investor behavior has large impacts on long-term outcomes when it comes to investing. So we'll touch on investor behavior a little bit more coming in the coming slides. It's important to consider the risk and have a good understanding of what your risks actually are. So some risks that we can point out here on this slide are economic risk, market risk, company-specific risk. This would be if you were to invest in, say, a single stock and something happens specifically to that company. Those concentrated risks can be fairly impactful. Interest rate risk, credit risk, and inflation risk. Inflation can be kind of the silent killer when it comes to a financial plan. So looking at these various different goods that we all purchase, right? A gallon of milk today costs about $4, but future costs, it's projected if inflation continues to be around 3% over the next 20 years, that milk will cost about $7.22 per gallon. Haircuts would go from $45 to $81. A pair of running shoes from $100 to $180, and a new car, the average car right now is $35,000, and a new car in 20 years would be projected to be about $63,000. The next step we're going to talk about is to assess your investment options. I've always thought that if I have a series of choices and none of them look great, then I just need more choices. So it's important to know what investment options you have. We're going to go through a few of them, but not all of them today. So the primary investment categories will be stocks, bonds, and cash alternatives. You can hold these investments in a number of different ways. You could hold an individual stock, bond, or you could own actual cash, or you can hold these investments in something like a mutual fund, an exchange traded fund, or an annuity. So why should we invest in stocks at all? We all know that stocks have higher levels of volatility, and stocks, because of that, have a little bit more risk, or substantially more risk. But over the course of the last 40 years, stocks have averaged almost 12%. That's 11.81% per year. That's a very strong return in spite of that volatility. One of the ways you can reduce your risk when investing in stocks is knowing and understanding when to use stocks. Stocks should be a long-term investment. Having a goal of purchasing a house in a few weeks or few months even, those investments should not be in a stock. That should be in a cash or cash alternative. But let's look at this slide. So over the course of a 1-year period, your risk or your chances of losing money in a stock since 1980 through 2019, you had a 17.5% chance of losing money. Now, on the other side of that, you had an 82.5% chance of making money in any one given year from 1980 through 2019. We're going to jump over the 5-year period, but let's look at the 10-year period. Over the course of 10 years, you only had a 6.5% chance of losing money over 10 years. On the other hand, you had a 93.5% chance of making money over a 10-year period. So the odds are much more in your favor over a longer period of time than if you were investing short term. So I'm not going to dive too far into stock valuations and volatility measurements in this presentation. I'm sure we'll have other educational opportunities to learn more specifics about that. But there are two key points that I want you to be aware of. One is being able to evaluate a stock. When we look at a stock and try to figure out a value, we often use something called a price to earnings ratio, also called a PE ratio oftentimes. We use this kind of like you would use a price per square foot in the real estate market. So if you had a stock that was worth $20 a share and you paid $2 per share for that stock, it would have a PE ratio of 10. You would take that PE ratio and you would do a couple things. One, you would compare it to its peers. So compare it to another publicly traded company that offers similar widgets or services. You would also compare that security to its historic average, right? So if it typically is trading at a PE ratio of 20 and today it's at 10, you would say that that stock was possibly at a discount. And then as far as a valuation of volatility, we often use something called beta. So you would choose a benchmark. Typically, this is the S&P 500. And you would say the beta for that benchmark is 1. Anything with a beta less than 1 would be less volatile relative to that benchmark. So if you have a beta of 0.6, that means that you are investing in a investment that has less volatility historically than the S&P 500. All right, so bonds and interest rates. So one really cool thing about bonds is there's a very clear if and then statement that you can make with bonds. When interest rates rise, the value of existing bonds goes down. The opposite is true as well. When interest rates fall, the value of existing bonds goes up. Now, in our current, as I'm doing this, our current interest rate environment, interest rates are extremely low. So we do want to be aware that if and when interest rates go back up, the value of the bonds that we currently own will go down. In this situation, or on the slide, you've invested $16,666 at an interest rate of 6% to get $1,000 in annual income. If interest rates were to go up to 8%, you would only need $12,500 to get the same $1,000 in annual income. One thing to be very aware of are the yields or the returns on cash alternatives, meaning money markets, CDs, and savings accounts are typically extremely low. You know, if you have a bunch of money in your savings account and you look at the little bit of interest that they give you, it's almost like they might as well have just kept it because it's not going to make any difference or impacting your life whatsoever. So that is a risk that you bear, is the fact that you're not earning money. Another risk that pertains to the safer investments like bonds and fixed, what we call fixed income investments. So bonds and also cash alternatives are the risk of inflation and also taxes. So if you have an investment of $20,000 with a 3% interest rate, you would earn $600 per year. If your federal income tax bracket is 32%, your after-tax return, meaning you've paid taxes on the 600, what you have left is going to be $408, giving you a total of $20,408. If inflation is 3%, which you then would factor in, your after-tax return and after inflation return, you have the equivalent of $19,814. This means we've very, very conservatively and safely lost almost 1%. So this is something we have to be careful of. So mutual funds and exchange traded funds. I do believe that probably a majority of investors would benefit from investing mostly in exchange traded funds and mutual funds. If the stress of purchasing individual stocks and researching companies at the point of purchase, but not only that, continuously looking into the company as time progresses is too much, then you really shouldn't be investing in individual securities. You should look at pooled investments like mutual funds. So a mutual fund may hold 100 or more stocks within that one mutual fund. Mutual funds have fund managers who are professionals at managing the fund, and exchange traded funds are typically invested linked to a benchmark, or some sort of investment strategy that is automated. So not my favorite slide here. What it shows is factual. It may just be semantics, but I would much rather see this slide say lower volatility to highest volatility. As we've already discussed and seen in the previous slide, that if you're not keeping up with inflation and taxes are eating up some of your returns, then you could safely lose money each year and still not hit your financial goals. So the least volatile to the most volatile is the way I see this. Least volatile being money market funds, municipal bond funds, income funds are typically composed of mostly bonds. Balanced funds has stocks and bonds. Growth and income funds also have stocks and bonds, but growth and income funds typically have more stocks than a balanced fund. Growth funds, international and global funds. International funds only hold non-US based companies, where global funds can own both US and international companies. And then sector funds are more volatile because they invest in single sectors and have less diversification, meaning when that sector is doing well, the fund does well, but if it does poorly, the fund does poorly. Let's talk about capital gains and losses. Short-term capital gains are investments that have appreciated or gone up in value, but you've held them for less than a year, whereas long-term capital gains, you've owned the investment for longer than a year, and that investment has appreciated. A capital loss is the same thing. Short-term losses, less than a year. Long-term losses, more than a year. So we have a little example here. So last year, Sam had capital gains and capital losses. His capital gains equal $4,000, but he had $10,000 in capital losses. Now, in order for Sam to actually be able to use these gains and losses, he would have to sell the investment that was either up or down. So Sam would then be able to use $4,000 of losses to offset the $4,000 of capital gains. This means that the the gains, he wouldn't have to pay taxes on those gains because it's a wash with the losses. He could take $3,000 of those capital losses and offset his income. So maybe he's employed, he's getting a check. Well, he can deduct $3,000 of income by offsetting some of those capital losses against his income. And then the remaining $3,000, there's something called a carry forward. He could use those losses the following year to offset future capital gains or income. So as far as tax treatment, so capital gains and also dividends are taxed slightly differently than your ordinary income. If you are a single filer and you've made less than $40,000 a year, you don't pay taxes on capital gains and dividends. If you are married filing joint, $80,000 is your limit. You won't pay taxes on capital gains and dividends. Once you've crossed that line, all the way from $40,000 all the way up to $441,000 or $496,000 if you're married filing jointly, you'll pay 15% in capital gains and dividend taxes. And then above and beyond that, you're looking at 20% in taxes. Utilizing fundamental investment tactics. So these are strategies that you could use to help you kind of weather some of the storms. So diversification, asset allocation, and dollar cost averaging. Diversification is pretty straightforward. Don't have all your investments in one sector. I also hear people say, don't put all your eggs in one basket. So if you put everything you own in one single stock or all in, say, one sector, maybe it's industrials or technology, then your portfolio is going to have more risk because you're not properly diversified. More areas of diversification. So you have large cap growth, large cap value, small cap growth, small cap value, dividend paying stocks, international, and low volatility. Another way to try to reduce some of the volatility is asset allocation. Choosing the proper asset allocation is important, especially relative to your goals and your risk tolerance. So this is a conservative investor. They have 50% of their portfolio in bonds, 20% of their portfolio in cash, and 30% of their portfolio in stocks. This would be a fairly conservative portfolio, and over the last 20 years, they've averaged 5.49%. Their absolute worst year was negative 10.85%, and their best year was up 18.08%. So all things considered, I would say that's a decent return for a very conservative investor. This investor is substantially more aggressive. Again, a 20-year time frame. Their best year is up 27.64%. Their worst year, however, negative 28.16% for an average return of 5.92%. So I just went back to the previous slide. Average annual return for a conservative investor over 20 years, 5.49% versus an aggressive investor, 5.92%. This doesn't seem substantial, but I assure you over 20 years, that difference in return would be substantial. Another tactic or strategy you can use is dollar cost averaging. This helps in a couple of different ways, but let's look at the analogy that we have here on the screen. This is an investor who's investing over a fairly short period of time. They put $1,000 into the market in $200 increments over the course of 5 months. The investment that they are purchasing, the share price is represented here, starts off at $6 per share. It goes down, it goes up, but over the course of investing each month, they're being consistent. The shares that they acquire here. So the first month, at $6, they put $200 in, and they get 33.3 shares of the stock. Month number 2, this would be a very bad fluctuation for this stock, but it's down, and it's down 50% in 1 month. But they were consistent in their investing, and they end up purchasing 66.7 shares, whereas the month before, they were only able to purchase half of those shares. This continues over the course of 5 months, and at the end, what's happened is their average price per share is $5.24, yet the average price per share that they were able to get is $4.65 per share, right? And that's because when the investment was down, they were purchasing more shares versus when the investment was up. All right, so let's put all of this together. And so this is what we can learn, okay? Stocks are more volatile, but over the course of time, you've seen a better return. So this chart is from 1995 through 2019. Stocks have averaged 10.22%. That's a good return. Corporate bonds have averaged 6.58%, and T-bills, which are short-term government bonds, they have averaged 2.24%. So what you're giving up in return, you're gaining a much smoother ride in the T-bills. And what you give up as far as a smooth ride, you gain in return when it comes to stocks. The goal would be to combine multiple assets to figure out what kind of ride you need to take to hit all of your goals safely and on time. I'm going to sum this slide up by saying we would all benefit by accepting the fact that market returns are somewhat unpredictable, and they're very unpredictable over a short-term period of time. Your investments should be related to your financial objectives more so than what we think the stock market's going to do tomorrow, because the truth is we don't know. I spoke about investor behavior a little bit earlier, and let's look at this. So if you were to hop out of the market and miss 12 of the best months in the market. This starts in 1990 through 2019. So if you just missed 12 of the best months over that time frame, what's happened is you have an annual return of 6.15%. It's not terrible, but it's also not the 9.96% that you would have had if you were to just stay invested. We're not talking about missing years here, just months. So it's very important that you stay invested. Again, we started off with the spare tire. Your portfolio has been built with the assumption that we're going to have down markets. That's baked in. What's not baked in is us jumping in and out of the market, trying to avoid down times, and oftentimes missing the recovery. Things that influence bad behavior: confirmation bias, chasing performance, reacting to headlines, and loss aversion. Loss aversion is very straightforward. Market's going down. I can't take it anymore. Please sell everything I have and put it into cash. That would be loss aversion. And again, that's where your risk tolerance comes into place. We try not to put you in that position in the first place. I have a client who's always talking about his FOMO, and FOMO is fear of missing out. And that would be chasing performance. You see something that's doing well as of today, and you want to jump in because it's done well. That causes you to purchase investments that are at high points versus low points. So you have to be careful about these things. Benjamin Graham was one of Warren Buffett's mentors. He said, the individual investor should act consistently as an investor and not a speculator. Another very well-known investor, Paul Samuelson, said investing should be more like watching paint dry or grass grow. So not too exciting there at all. So can you do it all yourself? I would say that yes, yeah, you probably can if you have the time and energy to. But I would also say that even someone who's in the business, a financial advisor like myself, I don't do it all myself. I have a CPA that I lean very heavily on, not just for myself, but for my clients. I have an estate planning attorney that I rely on for estate questions. I don't pretend to be an expert in every field. And if I wasn't a financial advisor, I would have a financial advisor to lean on for those things. So can you do it yourself? The answer is yes. Should you do it yourself? Well, that might be up to you. So you can do it yourself. You can work with us, or what many people do is they will get to it one day. It's the procrastination. You know, I honestly haven't seen too many people just procrastinating. I see more of the analysis paralysis, right? We need more facts. We need more facts before we get started. If I can say anything, whether you're going to jump on board and work with one of us financial advisors here at Wild Wealth, or do it yourself, get started today. So thank you. That's the presentation today. I do want to again offer a consultation with one of us advisors. Again, my name's Andrew Samuelson. You can meet with any one of us by just reaching out to at our number. It's 480-361-6203. Again, that's 480-361-6203. And just let them know that you've seen this video and that you're looking for a free consultation. During that consultation, we'll stress test your current portfolio and make sure that when the next financial crisis comes, that it's not going to derail you. Hopefully, the promise I made to you at the beginning of this video holds true and that you were able to get a return on this investment. Thank you, and you guys have a great day and a great night.